Hello, my name is Anthony, and today I'm going over the HOLT Valuation Challenge Stage 2. In this challenge, I must determine whether Intel will outperform or underperform. Looking at the HOLT Lens software, we can see a predicted warranted price of $38.74, or a whopping 88% upside. Let's look into this more closely. The relative wealth chart shows a consistently high CFROI that's always larger than the discount rate. This means Intel has done a good job at creating wealth. Looking at the second chart, we can see that Intel regularly grows its assets. We also notice here that the current price reflects an asset growth rate of around 0%, which would not match up with Intel's history or the predicted rate of fade. Why is this? Let's look at Intel's Q3 release for some information. The company experienced drops in PC revenue, which can be expected as the PC market has been declining. Looking at revenue compared to 2012, though, we can see that it's flat, while net income and earnings per share have risen both sequentially and year over year. Therefore, it seems incorrect to place asset growth at 0%, which is a decrease from present levels. Looking at a minimalist scenario, where assets grow by 3% yearly and CFROI fades to 9.65%, which is 1% lower than HOLT's default model, we can see that Intel remains undervalued. Let's now look at the warranted valuation information. In particular, notice that there are $21.90 in existing assets per share. Deduct the current debts of $2.25, and Intel's price ought to be valued at $20.89 per share, a modest increase from today's prices. Factoring in the value of any investments shows that Intel's warranted value would further rise. Combined, we can see that Intel's current assets per share minus debts places the company at a naturally higher value. Include a conservative asset growth rate, and it's easy to see that Intel will outperform.